If you are self-employed, there's a good chance that you are paying more in self-employment tax than you legally need to. And the frustrating part is that most people don't even realize they are overpaying until it's too late. It's not just income tax. It's an extra 15.3% on top of everything else. And most people just pay it year after year, because nobody ever explained to them that there are completely legal ways to reduce it. That's what we are fixing today. I am going to walk you through the strategies that actually work, and why they work. But a quick warning here. None of these work if you just copy what you see online. Every strategy requires proper setup. One wrong move can hurt you financially, and trigger an IRS audit. However, doing just one of these right can save the average business around $6,000 a year. So let's get into it. To beat this tax, you first have to understand exactly how and why the IRS calculates it. When you work a regular W-2 job, your employer splits Social Security and Medicare taxes with you. You each pay 7.65%. You never even see the employer's half. It just disappears before you get paid. But when you are self-employed, there's no employer, so you pay both halves, the full 15.3%. That covers 12.4% for Social Security and 2.9% for Medicare. This tax isn't calculated on your gross revenue. It's generally calculated on 92.35% of your net self-employment earnings after deductible business expenses. So if your business brings in $100,000 and your deductible expenses are $20,000, you owe self-employment tax on $80,000. That's $11,304 before you even start thinking about federal or state income tax. Now that you know exactly what you are dealing with, let's talk about how to bring that number down legally. The first strategy sounds basic, but it's where most self-employed people leave the most money on the table. Because self-employment tax is calculated using your net business income, every legitimate business deduction you take reduces the income on which self-employment tax is calculated. So deductions don't just reduce your income tax, they also reduce your self-employment tax bill. Here we are talking about things like home office, vehicle expenses, business software, subscriptions, tools, professional courses, business meals, equipment, and many other legitimate business deductions. The key word in all of this is legitimate. Every deduction needs documentation, like receipts, records, and mileage logs. If the IRS ever comes knocking, you need to prove it. This is also why your bookkeeping matters so much. You can't deduct what you can't prove. The CPA isn't just going to find deductions for you. They're going to make sure those deductions are categorized correctly and defensible if challenged. This next strategy is the heavy hitter. If your business clears a consistent net profit of $50,000 or more as a self-employed person, this strategy alone can save you thousands of dollars per year. Let's look at what this actually means with real numbers. When you operate as a sole proprietor or a single-member LLC, 92.35% of your net profit is subject to self-employment tax. When you elect S-Corp status, you split your income into two buckets. You pay yourself a reasonable salary, and that salary is subject to payroll taxes, which are the equivalent of self-employment tax. But any profit above that salary is distributed to you as an owner distribution, and owner distributions are not subject to self-employment or payroll taxes. This is where people usually realize how much money they're leaving on the table. Suppose you are netting $120,000 a year. As a sole proprietor, self-employment tax on $120,000 is roughly $16,956. But as an S-Corp, you pay yourself a reasonable salary of $70,000, and the remaining $50,000 comes out as a distribution. Payroll taxes now apply only to the $70,000 salary, which is around $10,710, and the remaining $50,000 distribution has no self-employment tax. That's a savings of roughly $6,000 every year in that particular scenario. Now, I want to be very clear about something. The word reasonable salary is doing a lot of work here. The IRS watches S corporations closely. If you pay yourself $1,000 in salary and take $119,000 as a distribution, that's a red flag, and the IRS can reclassify your distributions as wages. Your salary needs to reflect what you would have to pay someone else to do the same work. S-Corp election also comes with real costs, like payroll, additional tax filings, and other compliance requirements. Whether it makes sense for you or not depends on your income level, your business structure, your state, and a dozen other variables. If you want a deeper breakdown of when an S-Corp actually makes sense and when it doesn't, I have an entire video on that. I will link it in the description below. This is not a copy and paste decision. This should always be a real conversation with a CPA. Now, the final strategy is also one of the most misunderstood strategies out there. If you employ your children in your business, you may be able to reduce your self-employment tax while shifting income in a tax-efficient way. If you employ your children under 18 in a sole proprietorship, or a partnership where both partners are the parents. Their wages can be exempt from Social Security and Medicare taxes, provided you meet the IRS requirements. That means the wages you pay them can reduce your business profit, which lowers the amount of income subject to self-employment tax, without creating the same payroll tax burden that normally comes with hiring an employee. You still need to pay them a reasonable wage for the real work they actually perform. Their pay should match the value of the work they are doing. And if their income stays within the standard deduction threshold, they may owe little to no federal income tax on it either. Here's where people get into trouble. Number 1. Paying children for work they didn't do. Number 2. Paying unreasonably high wages. Number 3. Not running actual payroll. And number 4. Not documenting duties and hours. The IRS knows this strategy exists, and they look for abuse. The documentation requirements are real. If it's done correctly, hiring your children can be a legitimate way to move money through your business in a tax-efficient way. If it's done wrong, it can attract IRS scrutiny. Your CPA needs to make sure this is structured properly and that everything is documented from day one. None of these strategies are secrets. They are all right there in the tax code. But knowing they exist and actually executing them are two completely different things. Think about it. The S-Corp election has to be filed before strict deadlines. Family employment requires legitimate payroll records. Every single deduction needs clear, bulletproof receipts. Real tax planning is not a weekend project you tackle in April. It is a system you build into your business operations every single day. That is what separates people who overpay from business owners who legally keep their wealth. Algorithms, tax software, and YouTube videos cannot build that system for you. You need a real professional who looks at your actual numbers to design a personalized strategy. If you are running a business without a specialized CPA, it is likely the most expensive mistake you are making. The loss is not just the fee you pay, it's the thousands of dollars you leave on the table. Because you cannot simply copy-paste advice from a video, my team and I partner directly with a CPA firm that specializes in helping small businesses and self-employed professionals stop overpaying and start planning. If you want us to look at your business, fill out the form in the description below. It takes just 2 minutes to complete, and our team will reach out to you directly. If this video helped you understand what is actually possible, drop a comment with the strategy that surprised you the most. Also share this with your self-employed friend who is still blindly paying whatever their software tells them to. And if bookkeeping is the part you struggle with most, watch our bookkeeping guide next. It shows you how to build the record-keeping system that makes these tax strategies possible. I will see you in the next video.